everybody, and welcome to another episode of Taxes Schmaxes. I'm Edward Nisanov, and I'm here to save you money. On this episode, I'm actually going to show you how to travel back in time. Eddie, you've been reading too much of that tax code, you say. Oh, nay, you just watch and see. I wanted to talk to you about a common question that I get from my clients, and it's really about retirement planning. A great tool that's available to many taxpayers is an individual retirement account, or an IRA. There are two types of accounts. There's a traditional IRA account and a Roth IRA account. And I'm going to get into this in a few seconds. What I wanted to emphasize here is that if you're 22 and straight out of college and you don't have a 401k plan at work, it would be best to start investing when you're young. Because if you take somebody at 22 and you compare them to somebody that's in their 30s and they invest the same amount, the person at 22 is going to become a millionaire sooner than the person at 35. And the reason for that is the magic of compounding. So I can't emphasize this enough. I'm not saying that if you're in your 30s, you're lost. No, not at all. You should still utilize this. However, if you're young, the younger you are, the more opportunity you have. And that's with everything in life. And you'll see that as well. But now let's go back to the traditional and the Roth IRA. Huge confusion. Hopefully I can clarify it for you here. A traditional IRA account is an IRA account, or a retirement account, where you can contribute money on a pre-tax basis. Meaning, the money that you earn, you're going to put into this account and you're going to get a tax deduction, bringing it back up to a pre-tax level. So you don't essentially pay taxes on the money that you invest yet. That happens in the future. A Roth IRA account is a retirement account that you use post-tax or after-tax dollars to invest in. Meaning you receive the check from your employer or from work, and the money that you get after the taxes, you invest into that account. Now, what's the difference, right? With a traditional IRA account, you're going to pay taxes when you take the money out of the account. The Roth IRA account, on the other hand, because you've already paid taxes on it, is going to grow tax-free for the life of this account. And the other caveat here, the beauty of the Roth IRA account, is that you get to withdraw your contributions at any time without a penalty. A traditional IRA account, you would have a penalty. Both accounts have the same limitation, which is $5,500, and an additional $1,000 if you're 50 years or older. Now, these aren't for everybody. There are income limitations. So take a look at the link below. We're going to upload that for you and provide it there. See if you fall within that category to be able to utilize these accounts. Now, what if you're an employer? You own a small business, or you're self-employed, and you want to set up some sort of retirement account. You would essentially be able to utilize the Roth or traditional, assuming that you fall within the income limits. But what if you don't? There's an option for you here as well. You can use either a solo 401k, for example, or a SEP IRA. There are many others, but let's stick to those. And the difference between these is that the contribution limitations are huge compared to the other ones. You essentially get about 10 times more. You can contribute about $50,000. That's 50 into such an account. Amazing, right? You can start your retirement and actually boost it, not pay the tax on the entity level, sock it away for the future, and pay the tax then. Let this grow tax-free, and then pay taxes at the end. Fantastic savings tool. How can you go back in time, you ask? I promised you this. I'm going to tell you. The way to do it is this. These accounts can be funded the year after the closing year. Now, how do I say that in English? I'll tell you. 2017 already ended. We're well into 2018 now. And guess what? You forgot to make a contribution to either a traditional, a Roth, or a SEP IRA. And you're sitting in my office and you're telling me this and you say, Eddie, what now? I'll tell you what now. You can actually make a contribution to a prior year, meaning 2017, in 2018. If your mind's not blown yet, you just wait. Not only can you do that, for a SEP IRA, for example, you can fund this account by the due date of your tax return. So if you're on extension you're looking at October. Fantastic. You get a tax deduction for the 2015 tax year, or you get a tax benefit, for the 2017 tax year. I'm so many years back. And you do it in 2018. Phenomenal. I told you I'll take you back in time. Well, these are just a few simple strategies that you can use to lower that taxable income, keep more money in your pocket today, and save for the future. That's my 2 cents for today. Hope you enjoyed that. Hope you can utilize that in your tax planning strategy. And I look forward to seeing you next time. Thanks for watching. Hey everybody, thanks so much for watching. We hope you've been finding these videos informative, but they are for educational purposes only. Tax laws change on a regular basis, so we highly recommend you consult your tax professional and advisor, or give us a call to go over your particular tax scenario. Thanks so much for watching, and we'll catch you next time.